How's it going, everyone? I hope that you're all doing well. I want to welcome you to a brand new lecture for the 2025 Protocol series, where in this lecture, we're going to discuss targets. In the previous lectures, we've discussed entries and invalidation levels. Now I'm going to show you exactly how to identify your targets in a very mechanical way. And so without further ado, let's get into today's lecture. Now, in order to identify your targets, we're going to follow a very simple process. Now, if we just recap what we've done so far, we're assuming we have a drawn liquidity and a point of interest. Price reaches the point of interest, and then what we're anticipating is price expanding into the drawn liquidity. Now, the targets should be defined on the higher time frame. Why? While the original consolidation is going to be your target 1, and your drawn liquidity is going to be target 2. This makes life very simple because on the higher time frame, you should already know where you're getting out of the trades. Meaning, if we know the drawn liquidity and we know the original consolidation has been engineered below the drawn liquidity, then target 1 is going to be the original consolidation, and then target 2 is going to be the drawn liquidity. And for the bearish example, price has reached the point of interest. We now anticipate price continuing towards the drawn liquidity. Target 1 is the original consolidation, and then target 2 is that drawn liquidity. Now, how much should you take off at each target? And the answer is to take off more than 50% off at the original consolidation because this is your main target, and then the remaining portion at the drawn liquidity itself. Reason being is that original consolidation is your main target, and anything beyond that is just extra where you're anticipating price continuing towards the drawn liquidity. Now we're going to look at some examples so I can showcase this in practice, because as of right now, we're just discussing schematics. But just to summarize, target 1 is the original consolidation, and then target 2 is the drawn liquidity. Take off more than 50% off at the original consolidation and take the remaining off at the drawn liquidity. And remember, we identify these targets on the higher time frame, not on the lower time frame. Meaning, before we've even gone down to the lower time frame, once that point of interest is reached on the higher time frame, you should already know exactly where you're exiting because you know the original consolidation and you know the drawn liquidity. If we take a look at the first example, what we can see is that price had now retraced into this imbalance, meaning this is a retracement lower followed by expansion higher. This retracement lower is the original consolidation of a market maker buy model. So we're going to call this OC. What's the drawn liquidity? Well, we engineered this high below the fixed price level of 21,500, meaning this is my drawn liquidity. And so once price reaches my point of interest, before I've even dropped to the lower time frame, I know target 1, which is the original consolidation. This is where I'm going to take off most of the position. And then drawn liquidity is my target 2. I'll hold a runner towards the DOL. And if we just play price out to see what happens, price does in fact continue towards firstly the original consolidation, and then finally reaches the drawn liquidity, and then produces that high formation. Now just to prove to you, I took this trade. This is the 15th of May 2025, which is the same day as here, 15th of May 2025. And what we can see is that I'm trading a market maker buy model. I'm not taking partials at this high here. Why? Because this here is just an accumulation phase within the larger market maker buy model. You'll see that my target 1 is the previous day high, where I'm going to take off 80% of the position, and then I'm going to hold a runner towards the drawn liquidity, which was at 21,500 price level. And so what we see is target 1 is reached, previous day high, and then finally price continues higher. You can see my final target is 21,500, and then we can see the price does in fact reach that target during the PM session around 1 PM. And there we go, target reached. And so I bought down here, target 1, previous day high, target 2, 21,500. Why? Well, because this is my higher time frame, expansion higher, retracement lower into a point of interest, expand higher into the DOL, target 1, original consolidation, target 2, drawn liquidity. What we can see is another example here where my drawn liquidity was this sell side objective here. And what I saw was that price had retraced into this 1 hour bearish order block. And so I was anticipating retracement higher, expansion lower. If we go down to the 50-minute, we're going to see the retracement clearer. Price retraced higher into that hourly bearish order block. We've got retracement higher, anticipating expansion lower now into DOL. And so this is my OC, original consolidation. What we can see is the price expands then into my drawn liquidity, original consolidation target 1, drawn liquidity target 2. And just to showcase this trade, this is the 1 minute time frame, 6th of May 2025. If you just play price out, what you're going to see me do is take a short. What you're going to see in a moment is that I don't take any partials at the original consolidation, and instead I just protect my risk. Why? Well, because once the original consolidation is taken, that is your main target. And if you're confident your drawn liquidities can be reached, then you don't have to take any partials at the original consolidation and you can just hold towards your drawn liquidity. But you absolutely must protect your risk. And so what you're going to see now is once this low is taken, what you're going to see me do is move my stop loss to break even. Notice where this stop is right now. Once the low is taken, stop is now break even. Not taking any partials, but I'm just protecting my risk. And then what we see now is price retraces higher and then finally continues towards the drawn liquidity, meaning original consolidation was target 1, but even though we didn't take any partials here, we still treated it as if it was a target by moving our stop to break even and protecting our risk. And then finally, the drawn liquidity was reached. Once my target was reached, my drawn liquidity then became my POI. And what I saw was we had this high here, which is the original consolidation. And what I saw was that we had the 19,900 price level, which was above the original consolidation. Why is this the original consolidation? Well, because we've got a reversal occurring. So this is the original consolidation, left side of the curve, smart money reversal, right side of the curve. And so this was OC, being original consolidation. And then this was DOL, being 19,900. Target 1, original consolidation. Target 2, drawn liquidity. And what we'll see is that price did in fact continue higher towards the original consolidation. And then finally, the drawn liquidity. Now just to showcase, this is now the right side of the curve. We can see that original consolidation, left side of the curve, smart money reversal, right side of the curve. You're now going to see me take the trades. So now I'm in the trades. And what you'll see is this is my target 1. And then drawn liquidity being 19,900. Notice where my stop is. Once the original consolidation is taken, I haven't taken any partials. Why? Because I was very confident that my drawn liquidity would be reached, and so I'm not going to take any partials. But what I do need to do is make sure my stop is at or above break even, and it was because this was the new invalidation level due to the SMT. Refer back to the invalidations lecture. And then what we see is that price does in fact continue higher towards that drawn liquidity, 19,900. And so what I'm showcasing here is a slightly different method for targets. Target 1 is original consolidation. That is your main target. Target 2 is drawn liquidity. But if you're very confident that your drawn liquidity will be reached, then you don't have to take any partials at the original consolidation. You can just full pull it towards your drawn liquidity, which is what I did in both cases here. For the shorts, I full pulled towards the drawn liquidity. And for the long, I full pulled towards my drawn liquidity. But what I did know is that once that original consolidation is taken, it's possible that my drawn liquidity will not be reached and we will just reverse. And so what do I need to do? Protect my risk by moving my stop to break even or above in anticipation of price continuing through the original consolidation and into the drawn liquidity. If we look at one final example, what we can see is that price had reached my POI, being this sell side objective here, and my drawn liquidity was the AM session high, which is this price level here. Why? Well, because I was anticipating price reverting to the midnight open and the 20,000 price level. If you'll notice, the midnight open forms at the 20,000 price level. And so this was my drawn liquidity, but I was anticipating price continuing through the midnight open into the AM session high, where we took out the AM session low, which was this low here, and then revert to the AM session high. What we can see, we have the original consolidation, which is this price level here. Why? Well, we got retracement higher, expansion lower, and then we have now a reversal. And so this is the original consolidation. We also have another original consolidation, which is this level here, meaning we've now got multiple targets. Although we know the drawn liquidity is the AM session high, that's where we're going to get out. we've also got this buy sell liquidity pool here and this buy sell liquidity pool here. These are the respective original consolidations. And so what you do in this case is take most of the position off at the original consolidation, which is your main target, another partial at the second target, and then finally get out fully at the drawn liquidity. And what we see is that price then delivers that drawn liquidity. Target 1, target 2, and then target 3. So what I'm showcasing here is, although you might have a drawn liquidity and a original consolidation, there might be a level between those two levels that you'd like to take a partial. Maybe it's a buy sell liquidity pool or an imbalance or whatever. It's also possible to take a partial there. That's why sometimes you'll see me have multiple targets, not just two, because what I'm doing is saying, okay, I anticipate my drawn liquidity to be reached, but I also know that it may not be reached, and so I'm going to take partials at logical areas, being these buy side objectives. And this is the execution. You can see here we've got this buy side, and then AM high, which is my final target. And if we just play price out, you can see me enter long. Price then continues higher, and then during the final macro of the day, begins to expand higher. We reach target 1, original consolidation. I've taken 2 contracts off from 4 to 2. That's my main target. I'm then going to take another partial off here, 2 to 1 contracts at the next target. And then I'm finally going to fully get out of the trades at the AM session high, which is my drawn liquidity. And so what you'll notice here is that although I had my main target being the original consolidation and then my drawn liquidity, which is the AM high, because we took out the AM session low, as anticipating price reverting to AM high, I had an objective here, which was in between my drawn liquidity and original consolidation. And so I planned in advance, I'm also going to take a partial here instead of just taking target 1 here and then final target here. Remember, it's never a bad idea to take a partial, but the main thing is your first target is always the original consolidation. You shouldn't be taking any partials until that is reached. And then anything beyond that is just extra, so you can hold runners towards different objectives. Final objective being the drawn liquidity. And so that brings us to the end on today's lecture, where we've discussed targets. In the next lecture, we're going to move on to the optimization protocol, where we're going to discuss outcomes. So I hope you found some value from this lecture. And with that, I'll see you in the next video. Be safe.